Ever wondered how bonds work and why they are essential for investors? Let's dive into the fascinating world of bonds. Picture this. Bonds are like IOUs, a type of debt security. Governments, municipalities, corporations, and other entities issue them to raise capital. As an investor, when you buy a bond, you're essentially lending money to the issuer. But unlike a simple IOU, this loan agreement comes with a promise of regular interest payments, known as coupon payments, and the return of your initial investment, or principal, at a predetermined date known as the bond's maturity. The bond's face value, or par value, is the amount the issuer agrees to repay you at maturity. It's typically $1,000 or a multiple thereof. The coupon rate, on the other hand, is the annual interest rate paid on the bond, expressed as a percentage of the face value. Interestingly, these coupon payments are usually made twice a year. Now, it's important to note that bond prices are not fixed. They fluctuate in response to changes in interest rates, credit ratings, and other market conditions. Here's a key rule of thumb. When interest rates rise, bond prices typically fall, and vice versa. Bonds also have a maturity date, which is when the issuer repays the principal amount to you, the bondholder. They can be short-term bonds with a maturity of less than 1 year, intermediate-term bonds maturing between 1 to 10 years, or long-term bonds maturing after more than 10 years. In essence, when you buy a bond, you're lending money with the promise of regular interest payments and the return of your initial investment. This is just the tip of the iceberg. The bond market is a complex and diverse landscape, offering a wealth of opportunities for investors. Stay tuned as we continue to unravel the intricacies of bonds in our next segments. Now, let's dive into the inner workings of bonds. Bonds have key characteristics that define how they function and what they offer to investors. Let's start with the face value, also known as par value. This is the amount the issuer agrees to repay at maturity, typically $1,000 or a multiple thereof. The face value is essentially the loan amount, the money you're lending to the issuer when you buy the bond. Next up, we have the coupon rate. This is the annual interest rate paid on the bond, expressed as a percentage of the face value. These interest payments, or coupon payments, are usually made twice a year. It's akin to the interest you earn on your savings account, but in this case you're the bank, and the issuer is the borrower. Now here's an important concept to grasp: bond prices. They fluctuate in response to changes in interest rates, credit ratings, and other factors. When interest rates rise, bond prices typically fall, and vice versa. This is because as interest rates increase, newer bonds come with higher coupon rates, making older bonds with lower rates less attractive. The opposite happens when interest rates drop. Lastly, we have the maturity date. This is the date when the issuer repays the principal amount to the bondholders. Bonds can be short-term, with maturities less than a year, intermediate-term, with maturities of 1 to 10 years, or long-term, with maturities of more than 10 years. The longer the maturity, the more time there is for changes in interest rates to affect the bond's price, and hence its yield. These factors, face value, coupon rate, bond prices, and maturity date, all interact to determine a bond's yield, which is the total return you can expect if you hold the bond to its maturity. Remember, bond prices and interest rates have an inverse relationship. When one goes up, the other goes down. There are various types of bonds, each with its own set of features and risks. Let's dig into the fascinating world of bonds and explore some of the most common types that investors can choose from. First up, we have government bonds. These are issued by national governments, such as U.S. Treasury bonds. They're considered to be the safest type of bonds because they're backed by the full faith and credit of the government. Think of them as the superheroes of the bond world, reliable, always there when you need them, and prepared to save the day. Next, we have municipal bonds. These are issued by state and local governments to finance public projects like schools, roads, and utilities. The interest earned on municipal bonds is often exempt from federal income taxes. So, in a way, these bonds are like the community builders of the bond universe, helping to create and maintain the infrastructure we all rely on. Third, we have corporate bonds. These are issued by corporations to raise capital for various purposes, such as expansion or acquisitions. They offer higher yields than government bonds, but also carry higher credit risk. They're like the adventurous explorers, setting out to conquer new territories, but also facing the inherent risks of the unknown. Then there are high-yield bonds, also known as junk bonds. These are issued by companies with lower credit ratings and offer higher yields to compensate for the increased risk of default. They're the daredevils of the bond world, offering thrilling rides, but also carrying a higher risk of crashes. Finally, we have convertible bonds. These bonds can be converted into a predetermined number of shares of the issuer's common stock at the bondholder's option. They're like the transformers of bonds, able to morph into something completely different when the time is right. From safe government bonds to riskier high-yield bonds, there's a bond type for every investor's risk tolerance and investment goals. So whether you're a risk-averse saver or a thrill-seeking investor, there's a bond out there that's just right for you. While bonds can be a safe investment, they are not without risks. Just like any other investment options, bonds come with their own set of risks. Let's delve into some of the most common ones. First up is interest rate risk. This is the risk that bond prices will fall as interest rates rise. This is because when interest rates climb, the fixed interest payments of a bond become less attractive compared to other investments, causing the bond's price to drop. If you need to sell your bond before its maturity date in a climate of rising interest rates, you could end up making a loss. Next, we have credit risk. This is the risk that the issuer may default on its payments. If you're holding bonds from a corporation or a government that runs into financial trouble, there's a chance they might not be able to make their scheduled interest payments or return your principal when the bond matures. This risk is generally higher with corporate bonds, especially those of businesses with lower credit ratings, often referred to as junk bonds. Inflation risk is another major concern. This is the risk that inflation will erode the purchasing power of future bond payments. If the rate of inflation exceeds the interest rate you're receiving from a bond, then the real value or purchasing power of your investment is actually shrinking. Finally, there's call risk. This is the risk that the issuer may redeem the bond before maturity, typically when interest rates fall. If a bond is called, you'll get your principal back earlier than expected, which can be problematic if interest rates have dropped since you purchased the bond. You could be left trying to reinvest that money in a less favorable interest rate environment. Understanding these risks is crucial for making informed investment decisions. Just like a chef who knows the potential pitfalls of every ingredient in their dish, a savvy investor needs to understand the risks associated with bonds. By doing so, they can make better decisions about which bonds to add to their investment menu. Despite these risks, bonds offer several benefits that make them a valuable addition to any investment portfolio. Let's delve into these advantages. Firstly, bonds generate income. When you invest in bonds, you receive regular interest payments, also known as coupon payments. This steady stream of income can be highly appealing, especially for investors seeking a reliable return on their investment. Secondly, bonds can diversify your portfolio. Because bonds typically behave differently than stocks, they can help to balance out the ups and downs of the stock market, potentially reducing the overall risk of your portfolio. Lastly, bonds can help preserve your capital. High-quality bonds, in particular, offer a degree of principal protection. This means that even in times of market downturns, you can expect to receive the bond's face value back at maturity. With their predictable income and risk-mitigating properties, bonds are a crucial tool for investors. To sum it up, understanding bonds is essential for any serious investor. As we've discussed, bonds are debt securities that you can purchase to essentially lend money to the issuer. Whether it's a government, a corporation, or a municipality, the issuer agrees to pay you regular interest and return the principal amount when the bond matures. We've also delved into the mechanics of bonds, including their face value, coupon rate, price fluctuations, and maturity dates. Moreover, we've explored the diverse types of bonds available, from low-risk government bonds to high-yielding junk bonds. Of course, investing in bonds also comes with its share of risks, including interest rate risk, credit risk, inflation risk, and call risk. However, the benefits they offer, such as income generation, portfolio diversification and preservation of capital can make them a valuable asset in your investment toolkit. By understanding bonds, you are better equipped to diversify your portfolio, manage risk, and ultimately achieve your financial goals.